Hello again, I'm Nathan with Investing Ideas. Welcome to the continuation video from my first video, Investing for Beginners. This is Stock Fundamentals. I want to know a little bit more about how to evaluate stocks and how to figure out which ones are the best ones to invest in. Figure out is which company before us cost more. Now, it might seem like an easy question. Everyone would jump to Apple and say Apple costs $97. That's more than $50 of Microsoft. Well, it's a little bit more complicated than that. Price to earnings ratios, we can see that the price per share divided by the earnings per share gives us a number, a ratio. That ratio tells us relatively how expensive that stock is based on how much it earns. Think about it from the perspective of a company earning money. The company that earns more money should be worth more money. It's pretty basic. And if we look at that, we realize that Apple is significantly cheaper than Microsoft. Now, there could be a lot of things that determine this. It could be they are in different sectors, and those sectors are earning more price to earnings ratio. There's a lot of different things, but from a basic standpoint, you can understand price to earnings ratio is effectively how expensive the stock based on its earnings. Some of the pricing tools that you may find in your Explorers are price to book, price to sales, and PEG ratio. The one I want to concentrate on here is price to growth ratio, or the PEG ratio. This is one that has been used in the past to evaluate Google, and now is being used to evaluate big name companies like Facebook, Amazon, Netflix. When you find a company that has an extremely high price to earnings ratio, it could be being evaluated on a completely different basis, like a price to book, so price to sales, or PEG ratio. Price to PEG ratio, as I was saying, is the ratio, the PE ratio divided by the growth rate of its earnings over a specific time. So basically, if the company is growing a lot faster, then it kind of deserves a higher price tag because of its growth potential. The last one is an interesting one that I discovered later in my investing, which is EV over EBITDA, or enterprise value versus earnings before taxes and amortization. A lot of people think this is what some of the higher level investors use. You can find this ratio calculated for you on Yahoo Finance. The calculation here is listed, but basically what it's looking at is the total value of the company. It's a measure of the company's value versus how much money it can generate. A fair market value for that is considered to be 13. This has often been referred to as a golden ratio for the fair market value of EBITDA. Next, I want to move on to earnings per share. This is something you'll need to become familiar with when looking at companies, and it's simply taking the total number of earnings they have per year and dividing it by its market cap, aka the number of shares. That gives us an easy way to compare one company to the other on its earnings potentials. EPS will be a common factor that we want to look at when we're evaluating companies. Why do stock prices change? Well, there's a lot of effects that can affect stock prices. Simply, the most common, supply and demand. The more supply of a stock or the more demand of a stock will affect its price. Positive or negative news, company's performance, insider action. This is where insiders may be selling or buying stocks, sending out possibly negative or positive signals. Dividend growth. Company that decides, hey, we can afford a higher dividend, and they start paying more, which would affect its overall yield, which we discussed in the previous video, which is very favorable. Stock buybacks is another way for companies to give money back to the investors. They do it by simply taking extra shares off the market. So they'll go out and they'll actually use money to buy shares off the open market. That limits the supply of shares available, while also reducing the number of shares that they have to pay a dividend on in the long term, and it actually is beneficial for the company and consequently the shareholder. Then you have secondary offerings, or as I refer to them, stock dilution. This is basically the opposite of a buyback, where the company needs to make acquisitions or expansion or buy new machinery or whatever have you. They need to raise capital. They do so in a secondary offering, which means they basically release more shares on the open market in order to raise capital. It can be a negative or it could be a positive depending on what they plan on doing. Secondary offerings and stock dilution are actually quite normal in a growth of a young company. They use that money to grow their business. If you look at the number of shares outstanding in Facebook and Amazon, I'm sure you'll see increasing numbers of shares that they're issuing in order to pay for things and expand their company. As long as the company continues to be popular and profitable or growing, it's never really looked at as a bad thing. However, if the company is not doing well, it could be a bad thing. And then the overall market trend or sector trends. So sectors kind of go up and down. This is a doubling effect with the ETFs nowadays. But overall, the market, if the market overall goes down, if the market's in a bad slump, then all stocks will go down. The old saying that rising tide raises all ships, the same can be said for sinking. The next side is company performance. Making the estimates or earnings or revenue, sales, and growth, these areas will actually affect how the company performs. If it continues to make or beat earnings, or revenue, sales, or growth, then its price will continue to rise. If it misses those, then the company's stock will lower. There's something called guiding up and guiding down. That's where the company changes what they believe they will make in the future, or to the positive or the negative side. There's debt up and debt down. There's increasing debt, which could be liability to the company, or there's decreasing debt. Debt not necessarily has to be a negative, depends on what they plan on using the money for. And then increasing or cutting the dividend. Increasing the dividend, as we already discussed, is a good thing. Cutting the dividend is a negative thing. And then the basic cost of operations. If a company comes out and says that the cost of operations is going up, that can generally become a negative and the stock price can be pushed down. Ultimately, as you can see, there's a lot of things that factor into stock prices. What should I invest in? Well, first off, I think that you want to have two phases to your investment idea. The first one is a core, basically core portfolio of diversification, established companies, an index fund, dividend-paying stocks. What I'm looking for here is a kind of a backbone to your portfolio, something that you can always trust. It's in solid, good companies. You want to diversify. You don't want to have all your money in the same sectors. If you have a bunch of tech stocks or oil stocks, if one of those sectors gets hit, then your portfolio will get damaged. You want to look for established, well-known companies that have a good track record. And as I discussed in the previous video, you want to have some index funds where you're basically just going to follow the market. The S&P 500 is the bar which all mutual funds try to achieve. So that's the one we look at. That being said, there are many index funds out there. The final one, you want to look for dividend-paying stocks, and you want to put them on what's called dividend reinvestment program, or DRIP. This is where you get the functions of compounding interest in your stocks. Essentially, when the stock pays a dividend, your brokerage will automatically buy more shares, however many shares, even fractions of shares of that company that paid the dividend. So in theory, what you'll have is every quarter more shares of the company that's paying you the dividend, which means the next quarter you'll have one or two more shares of that company to help give you more money, and it just keeps on compounding and growing. Phase 2 is what I call the catalyst phase. That's where you want to start looking for opportunities, looking for value, looking for the growth. You can start speculating, looking at trends, and just looking at what's going on in the world. If you ever wanted to go out and jump into the next hot thing, that's great, that's awesome, that's phase 2 of catalyst. But you want to have a good, solid, diversified core before you jump into catalyst investing to make sure that all your money is not lost in one of your plays. Value plays would be looking for a company that's been beaten down over and over again, but just has so much going for it that it's bound to recover. Growth, we could look at something like an Amazon that just keeps seemingly growing and growing and growing as we will just hop on board with it, knowing that eventually it's not going to be able to grow anymore, and then that stock price will have to pull back. But whether or not we get in that stock at the right time and get out at the right time will matter a lot. Speculation is where we go out and just try to figure out what's going to be the next big thing. And then trends are simply just that, trends. Trend would be stay-at-home economy, where people want to stay in and watch movies, vice go out. There's a lot of investments that go with that. That kind of piggybacks on what's going on in the world, what's happening, what's changing. Just keep your eyes out. If you have kids, figure out what they're into, because guess what? They're the next generation, and they're the ones that are going to spend money going forward. On what are they spending money? You should be asking yourself. That concludes this session of stock fundamentals. If you're really interested in what's going on here and you want to learn more about the best time to get into stocks, look into my next video on stock technicals. Thank you for watching.